Welcome to the Strothman Strategic Advisory Series Roundtable. My name is Matthew Saltzman. I am the Director of Strategic Advisory Services. In these uncertain times, information is power. Things are moving so quickly that if you blink, it's different. Here at Strothman & Company, we believe that the more information we can provide to our clients and friends, the better we can serve them. Our desire is to provide you with key insights and information that you can use and can't get anywhere else. In that spirit, we created this roundtable series to get you the information directly from the people who make the decisions. This monthly roundtable series will allow you to listen to the key business leaders in our community, discuss the topics that are impacting you daily, and tell you what these leaders are really thinking. Each month, we will be holding conversations with key leaders in banking, law, government, financial services, and other critical economic sectors. And our mission is to provide you with the opportunity to watch the conversation from the inside. These conversations are unscripted and will touch on many topics, some of them controversial. I hope you enjoy, and thank you for watching. I want to welcome you to our second roundtable. Today, the topic is going to be related to transactions in the current marketplace. As everyone knows, information is key. And in these uncertain times, the information that we have at our disposal is not always the best or the fullest that we've had in the past. Today, we're going to look at how the market is reacting to this lack of information, to the changing environment, and to the uncertainty in both financials and in the ability of the companies to measure what the results or what the performance is going to be. With me today, I have the fortunate experience of having very, very good partners in Colin Holliday from Passanelli, Tony Pesavento from Titan Equity, Scott Dolson will be from Frost Brown Todd, Neil Bordy from Sauer Waterman, Lee Garlove from Middleton Reitlinger is joined us, Darren McCauley from Old National is with us as well and will be on the banking side. And what I'd like to start out with is a really simple question that has a lot of answers to it. And that is, given the current environment, are transactions possible in the current market? And I'd like to start probably with Neil, because in this environment, we're hearing a lot of noise about companies that may or may not be getting ready to file for a chapter filing or a reorganization, or maybe having trouble coming out of the shutdown. And I think that's a good place to start the conversation, which is, Neil, what are you seeing out there in terms of those types of activities, and what are you hearing from the clients on the street?
Okay. Well, we received quite a few phone calls and a concern about the future. Right now, bankruptcy filings are not taking off like I think they will in probably 3 months. I think you're probably looking at 3 or 4 months. You still have all this PPP money that is out there, and you've got creditors. Really, bankruptcies are pushed by creditors, filing suit, attempting to collect, pushing the companies to pay. And that's just now starting. In June, they started allowing landlords to, start eviction process. So, you went for March, April, and May with no evictions. And just now, you're starting to schedule evictions. And so that's going to spur some companies. But it's kind of a wait and see for most companies right now. I've received calls from numerous restaurants, as you all can imagine. A couple manufacturing companies that have been affected, and then retail is another area that's going to be greatly affected. Although to be honest, I've received one call from a retail company, and so right now, while I have sent engagement letters and been employed by 3 or 4 or 5 companies, I have not filed any bankruptcies for these companies in the past few weeks. But I think it's going to take time to evaluate, where they're at. Can they come out of this what their financial future looks like, and to then determine what's the best option for them to go into Chapter 11, try to reorganize. Obviously, you're going to try to negotiate first before that occurs, and some you're going to be able to negotiate. Some are not going to be able to come out. I mean, there's certainly, right now, numerous, especially in the restaurant business, that we're seeing that these restaurants are not, many of them are not going to be able to survive.
Darren, what do you, and this is going to be mostly conversational, so guys, just jump in wherever you want. But Darren, from a bank's perspective, are you hearing and seeing some of the same things as well from your clients, getting a little squeamish, asking for help, that kind of stuff beyond the PPP?
Well, as we came into March, we were really in the middle of a deferral program for a lot of clients who we saw the shutdown was going to slow down. Restaurants is a great example of that. You saw some office complexes asking for some relief on principal payments for 90 days and back end loading some of that. And in a lot of cases with the banks, you could do that if they were in proper equity positions. As a general rule, what I've seen with the client base I see in a 4 or 5 state area is kind of a group of haves and a group of have-nots. There are several companies that are just doing very well and almost in a point where they're somewhat expanding or surprised with their results. And there are others that are just struggling, have survived with PPP and some of the government programs and are trying to determine how quick they can come back or not. And you see that really in the unemployment numbers. As PPP wears off, they're kind of right sizing, and we're all kind of hoping that the fourth quarter and the first quarter of next year looks somewhat more normal, depending on how all this opens up and if we have a second wave. But I really see haves and have-nots. The banks were working on deferral programs, trying to help good clients and those in need. PPP ran them all asleep, and now we're kind of opening up our doors again, waking up and going, okay, what's next? Which is part of what this conference call is about.
Yes, exactly. And Scott, in your world, what are you seeing out there? And then, guys, just go ahead and take it over from there and just chime in where you want.
Well, I think I would say I probably am similar to probably a lot of M&A lawyers. I had one really large deal that got put on hold. Basically, the buyer it was big LBO, their buyer and their lenders backed off the deal. I had a kind of a small, medium-sized deal that basically got put on the shelf. And I think they're all sort of like, well, we're deferring this, but you don't know. They may not come back. They may come back. So that, that's kind of the old deals. And then, everything sort of went radio silent for, 6 weeks or 2 months or something like that as we kind of played it out. In the last, 2 or 3 weeks, I'm kind of back in business, I guess, got several deals going. One, I've got a client responding to a sale process, in a construction area. I've got a IP type transaction, a sale, and I think what you're seeing on those, they're not the big deals that require an extensive financing package. They're more the one's kind of in the $10 to $15 million range, and I think basically the buyer has the money to pay for it, and the other deal, the client's a strategic purchase, the client has the money. So I think what you're seeing is it's a reflection, the family office has the 15 million bucks. I mean, and that's a reflection of everything you read. I mean, I've forgotten the number now. It's some ridiculous amount of money that private equity firms have committed to them. I don't know if it's billions, but it's almost $1 billion or something they can draw down on. And, so they need to do some deals. So they're going to, some of them are getting back in action using that money, and maybe direct lenders or some mezz lenders are getting into the game. So I think I'm seeing that, and I'm getting more phone calls, kind of my other line of business, but it ties into this, is working with people who, want to take advantage of Section 1202's gain exclusion, and that's sale of stock. So, that went silent for a couple months, and now I'm seeing people calling me. I got like 4 phone calls. I got 2 introductory calls later today. Those are entrepreneurs, founders who have stock, and they're back in planning for their sale process, and that's a sign that things are getting going again. So that's what I'm seeing. But I'm not. I don't know what's going on with the big lenders. I just asked one of our group here that question, and and I haven't seen any action in that area yet. So I don't know if the big LBOs will be coming back, in the near future. But the smaller deals, I think, will be going where people have the money or can tap a direct lender, one of these, PE type lender types that you meet at these big conferences, and typically, you run into them, you talk to them, but now's the time where I think they'll have their day in the sun.
Colin, what are you seeing out there? You're an M&A attorney also on a different side. Do you see a lot of what Scott's seeing?
Yeah, it's interesting. We closed, my team here closed 3 transactions between mid-March and May 1st. Those transactions were pretty far along, though. So those transactions already had drafts of definitive documents that were pretty far along, and all 3 of those closed. It's interesting. Those one of those was in construction, one of those was in real estate services, one of those was in life sciences. We did lose some transactions. Really, those were very early stage. Pre-LOI or LOIs had just been signed, and those transactions were put on ice. I agree with Scott. Over the last 3 to 4 weeks, the pipeline is picking back up. There's a large behavioral health transaction going on. There's a specialty pharmacy transaction, a healthcare technology transaction, and then a logistics one as well. And so when you look at pre or right when the COVID cliff hit, those deals kept going across a spectrum of industries. What I'm seeing now is more, I guess 75% of the pipeline now is healthcare related, which has come back. It has bounced back since a lot of states have reduced restrictions on elective surgeries. And from a healthcare standpoint, Matt, it was really fascinating for me as an M&A attorney. I didn't realize. I was thinking elective healthcare would be healthcare that insurance wouldn't pay for. Instead, elective healthcare became open heart procedures that could be delayed. Maybe at the Cleveland Clinic that had a huge spike of corona cases, and so instead of going under the knife for open heart surgery, today you might delay that for 2 months. And so there were significant issues with elective procedures, but that's really bounced back now, which is also some of the M&A activity.
So most of what so most of what it is it seems to be somewhat opportunistic at the moment in many cases, and larger deals that you're seeing that are coming through, or are they more of the smaller, lower middle market deals that we work on, the 10, 5, 10, 15, $20 million transactions, or they seem to be of larger scale?
Yeah, right now for me, it's it's mainly lower middle market. There is a large deal that continues to go and should continue to go based on its industry. But right now, it's from I think it was said earlier, not a lot going on that involves multiple outside financing sources. It's more private equity funds that have the dry powder that are getting ready to get back in the game, or strategics.
Which is an interesting topic in and of itself. Is the PEs have dry powder, the family offices have dry powder, but they also have portfolio companies. And you wonder, where would they in normal circumstances be putting their money? Are they feeding their own, or are they bringing on new problem children into the family? And so when you look at that, Tony, I know that your portfolio is fairly healthy and fairly constrained, but what are you hearing from others out there? And as a PE guy, how would you look at that?
Well, obviously, you got to deal, just as with a bank or any other investment group, you got to deal with the problems you have and the triage department, if you will. We're in the fortunate position this year. We're not completely over levered in all our companies. There are other years this would have been devastating to us, and we wouldn't be thinking about new deals. But just by happenstance, that's not the case. So we have money to spend. I'm looking at one new deal. Just frankly, we're a smaller group, and this is the first deal we've seen that's kind of a new deal. It's in food, so I called around to a couple of mez guys, and it was almost as if I was waking them up. Yeah, we want that. That's right. We want to tell me about that deal. I almost caught them off guard, saying we need 5 or 10 million a mez. Turn and a half. Where do you see capital structures? It was as if they were just entering into the business again. So I think people have either been on siesta or whatever you want to say, traveling the country, Matt. Doing other things. But people are ready to get back. We had one transaction, a company that we're selling that was pretty far along, but about a month away from closing. It's going to close end of March, early April. And that got shut down. I talked with the buyer earlier this week, and we just agreed that, at 60 days from now, we're going to have the June and July financials. It's in automotive, so it's just kind of revving up again. And then we'll sort of see where we are. If you have a company in an industry that's been shut down, I just don't see any deals getting done in those areas in the foreseeable future. But if you were essential, then it's a question of how quickly you get back to a new normal, I think.
Right. And that's an interesting perspective, because what you're really saying underneath all that is, what are the things that we normally would walk over and not think was much of a problem that today, now they're problems? For example, in many cases, you never really considered real estate to be much of an issue unless it had, toxic waste in the ground, or the building was falling apart and had asbestos in it. It didn't seem to be much of an issue, but given everything that's gone on, you have to think about real estate twice. You have to think about the location. You have to think about excess capacity, whether or not you could run single or double shifts in some of the manufacturing, because the plant is good for one shift or 1.5 shifts, but it's really not built for split shifts, and there's not enough capacity there to get you back. Lee, as you go through and talk to your clients, what have you been hearing?
It's very interesting out there, and for those of us, and I think everyone on this call lived through 2008. I think people are just looking back to see what parallels do we have with 2008 and the Great Recession, where real estate was, you couldn't unload real estate. But then it had an uptick. But even before COVID, you had the murmurs of the brick and mortar being beaten down by the online companies. And so what you had are people looking at the portfolios and saying, what type of brick and mortar retail do we have? And then we go through, or we're not through it, but we're in the COVID, and now office space is really being looked at, because people have really looked at working at home. And you read daily about large companies saying we are downsizing substantially with our office space. So we had retail that was really suspect, and now you're looking at the office space, which is suspect. So it really is a concern. The deals we have seen, we've actually seen some deals going through, but it's a playing with the interest rates, and it's owner financing type of arrangements where the owner thinks they can get a little more interest than what the interest rate is out there on the investment side.
Right. So that really brings us to the key topic, which is, given all these things that everybody's talking about, how would one measure value and determine valuation at this point? Yes, deals can get done, but you have to be pretty smart and pretty careful on how to value this thing, because in a leveraged deal, if you misstep, you're multiplying your misstep by that leverage. And in a lower interest rate environment where you're buying a 8 to 10 year run to get your money back, if you're going to pay any kind of multiples, how long will these interest rates stay where they are, and how long will the banks be able to keep you in there? For example, can we all go to Darren and ask him for a 2% loan for the next 10 years fixed? And is he going to give it to us? So at this point, what I'd like to do is just open it up to all of you and answer the question. Just take it as you want. How do you guys approach the value question and determine that valuation? And what are the issues that you're seeing as you counsel your clients or as you try to do deals yourselves?
Well, I think one little piece of the answer is, sort of my experience. I was working on a large gaming industry transaction that I wish I was like Colin, who's got all his deals closed. This deal did not get closed, and I don't know what you want to say. It's a very large deal that got kind of put on the shelf. And I think the short answer on that is, for types of industries like that, I think they're basically kind of on hold. I mean, you can't, if people aren't going into, casinos and things aren't happening yet, or they're basically rolling out and then rolling back, I don't think Darren or anybody else is going to lend, $300-400 million in any kind of syndicated loan for an LBO of that type of business until we kind of see which way the wind's blowing. So I think that's the answer there. I mean, the technical stuff is, how do we look at, this year's earnings and try to figure out how to price it? But I think there's a certain segment of industries where you're just not going to, I think people are going to, step back and see what happens,
So is that going to lead us to multiple contraction, or Darren, in your case, not stepping up to do the loans that need to be done in a fresh way, or Tony, in your case, looking at, again, multiple contraction, things like that? Where do those things come from? Or Colin, what are you advising your clients in terms of the obligations to get into on these deal structures? And how does the whole deck reshuffle? That's really, you guys all have answers to it in one way or another. So just let me know what you think.
Let me jump in with a quick comment, and I'll say two things that I've talked to clients about. One thing that you're seeing, even though what I call cost of fund rates have gone down for the banks, the spread that we're charging, the credit spread, has gone up dramatically. So arguably the cost to the client hasn't dropped, probably has gone up, because credit spreads have risen more than the rates have dropped. You can kind of track that versus U.S. Treasuries versus corporate bonds. That gap between those rates, kind of the risk-free rate of the government versus the riskier rate of corporates, has widened dramatically. So as I coach clients, I wouldn't be as concerned about rate today as I would as access to capital. And I think the banks, who are probably the slowest to react positively in deal structures, to Scott's point, it's all going to be how confident do the banks believe that this management team and their industry can get back to what 19 was. But I think the overall senior bank deal structure will be less funded debt to EBITDA multiples that they're going to be comfortable doing, and it's going to require more equity in these family businesses, these halves, putting in more cash in a true senior structure, which is going to bring up other sources and the tricks of the game. So from a bank standpoint, I keep coaching clients. You want access to capital, the rate's one thing. Don't be overly concerned. You're not going to see dramatic rate changes because credit spreads are up, and they're probably going to be up for the next 6, 9, 12 months as all this noise comes through everybody's numbers.
Darren, this is Lee. Just a question. Do you see a limit on capital in the same as we had in 2008, or can you draw distinctions between the two time periods?
Well, and not to pick on my brethren at Wells Fargo, but for instance, they stopped their PPP program because of capital allocations. And I'm not picking on them. It's just public bank, public record type information. So, yes, I think as the regulators who are rear view mirror analysts, and I'm not saying in a mean way, but they'd run into a brick wall looking at the rear view mirror in their car, they will force capital structures at banks. It's a lagging indication, but I think later in the year, you'll see pressure that the banks carry more capital, which will constrict. Again, I go back to, I think banks are going to handle their clients as best they can and be less apt to help other banks and or stretch out on prospects as much as they would. So bank relationships become even more important as a lot of clients learned in the PPP program. So, yeah, I do see the OCC and others reacting in a lagging fashion here in the second half of the year, making it tougher.
And then as we see that, Colin, you've done multiple size transactions, some large, some smaller. Are you seeing a distinction between the size of the transaction and the access to capital, or not?
Yeah, I am. I mean, the right now, what I'm seeing, the larger the transactions, the more skittish financing sources are. It is interesting, Matt. I mean, you'd ask about multiples, and I felt like we were in what I call the sloppy seller's market, right? I mean, it was as sloppy as it had been since I saw it in 2007, meaning that it was so seller friendly on the end of the spectrum with the competition for transactions that you were starting to see deals done that you were just scratching your head at some of the terms or sometimes lack thereof. Right now, I'm not willing to say that now we're in a buyer's market. I do think, though, it's pulled back to where I would say right now it's neutral as everyone's trying to figure out what that looks like. And so for multiples, if you're in an e-commerce business, you're not seeing much different. Some of the specialty kind of roll-up business, your vet type spaces, still really high multiples. Then you get into, as some have mentioned on this call, your retail, your restaurants. Clearly, those multiples from what I've seen are coming down, and so it is it's gone from used to, it could be a industry valuation of looking at multiples. Now it's really a subset of industries trying to get a feel for multiples and looking for enough data to come up with statistically significant opinions on what those look
like. Now, Matt, I'm kind of in a different arena than everybody else here. My clients are, clients that are struggling, and going back to like what Lee said in 2008, 2009, 2010. I ran into a lot of clients who came to see me who were current with their creditors, but in dealing with their banks because of the type of business, whether it was real estate related or another area that banks didn't have confidence in, the banks were not renewing lines of credit. And that caused a major problem for a lot of businesses. So maybe I, direct this to Darren, whether there's any discussion right now as to, our restaurants or retail are those type of businesses going to be looked upon differently going forward than businesses that obviously have been unaffected by COVID?
Yeah, I think the unfortunate answer is yes. It's interesting having a few restaurant clients, those who have drive-throughs, and I can talk about one publicly, say Texas Roadhouse, who really mobilized what I call their parking lot carryout business, and weren't particularly leveraged going in. I'm not sure. I'm pretty sure that Texas Roadhouse had over $100 million in cash going into this without any debt. So some were positioned pretty well. And again, I go back to this have or have nots. I deal with some Wendy's franchisees who had a slow downturn, then got their drive-throughs up and running, and in most cases their numbers are up. And then you can fight, say, a Cheddar's or a sit-down type situation where their numbers are really way off because they weren't built for carry-out. They've tried to do that, but yes, we're scrutinizing hospitality. We're scrutinizing retail, some office. We're clearly scrutinizing restaurants, which in the Louisville area is a big category differently. And I would say the confidence that our credit teams have to try and help them dig out in traditional lending is pretty tough order right now.
Well, to be expected.
Yeah.
And actually, Neil, when you look at it, which brings me to another topic, which is really the same topic, the opportunistic aspect of these deals, as you see the activity coming through your end of the spectrum, do you see people that maybe don't want to go through another cycle of this to get through, they're ready to retire? There are certain companies that really would be better served married up with another company, to Darren's point of the haves and the have not, which is really big versus small. Size matters at this point in this market, and you can see it on Wall Street and you can see it on Main Street. But as you see the flow coming through, it's not just retail and it's not just restaurants or travel. There's an enormous amount of industries, small manufacturers whose supply chain hasn't come back online yet, or whose demand side hasn't come back on because they supply into the automotive, weren't well capitalized, poor balance sheets going in. And once the PPP is gone and the top line is not there, how are they going to get through this? And then to couple it on top of that, they only have one set of management, but the COVID restrictions forces them to space people, so they can't get them all in the factory on top of each other at one time either. And they have all these other implications. Are you seeing that there are going to be what formerly were decent to good companies now struggling to be decent and are going to need to match up with somebody else, need to sell out, may need just to go out of business? And what are you seeing there?
Well, I think there's a lot of opportunity, but as everybody has said, there's the scrutiny right now is very heavy. I mean, you're not seeing people, at least not yet, jump in and try to acquire small businesses. That may happen in the next few months, but right now, the business environment that I see are people really just trying to determine whether they can survive for another 3 to 6 months, and hopefully things turn around. And if they believe they can, they're going to do everything we're going to do everything we can to keep them in business. Obviously, the last resort would be to put them in a bankruptcy, a reorganization. But that's certainly, I think, we're going to see a lot of small businesses go into reorganization probably in the next 3 to 6 months, because they're going to have the belief that they can come out of this, but because of their current financial condition, they're just going to need help. And then it just depends on where creditors are as far as working with them. Right now, I'm spending most of my time doing workouts, dealing with equipment, creditors, dealing with some banks, dealing with just the general vendors and trying to work out a payment plan for these companies and buy them some time to see if they can make it or if they can't.
Right. And are they willing to make the change that are necessary to get there? It's not just about cutting; it's about managing underneath it and really making some fundamental changes, because there were a number of businesses. To Colin's point, that it was a seller's market before. It's pretty frothy, and there was a lot of excess in the market without a lot of discipline. We ran into a lot of companies that they were getting by, but you knew that if there was a problem, there was going to be a big problem. And in its current structure, are these companies willing to do the things that are necessary to make the fundamental changes for the long run? And what does that really say about future unemployment and those kinds of things that Darren touched on earlier?
Yeah, I think some of the companies obviously can see what needs to be done, at least in their mind, to survive. Others who want to continue on just the way they had, and they just want to hold on for 3 months, and they feel confident it's going to turn around. Generally, those are the companies who are not going to survive. I mean, in this environment, if you're going through financial trouble, you've got to formulate a plan to make changes. And changes can be employee related. It can be business related as far as what customers you pursue. But if you don't acknowledge that changes need to be made, generally you're going to have some severe problems. And it's really kind of too early right now to, certainly some companies I've dealt with have made some changes, but it's kind of early for them to formulate. There's no one, there's still this unknown as to how quickly their business is going to bounce back.
Right. Are other people out there dealing with the unknowns? Tony, we had talked about this the other day, that when we talked about doing this, one of the things you said to him was, "I don't know anything. I don't know what's going to happen."
Well, there's a more positive way of saying that, I'm quite sure, but my marketing skills are modest. It's hard to do a deal when you can't be smart about what you're buying, and what you're buying into is the future. And so as long as any company that was unaffected by COVID, I just think there's very little that's going to change about multiples. Maybe it'll be a little less frothy, Colin. I certainly agree with that. But I think there'll be an adjustment in the deal structure. And you're going to have maybe one turn in a 6 or 7 times EBITDA deal that's going to be stellar financing of some sort, where you're going to have a little bit different risk sharing model, because the lenders are going to pull back and the equity people, are still going to want a certain return. If it's been affected by COVID, that's much more challenging. Everybody talks about, EBITDA C. And if it's a little dimple in the returns that can be easily filled up by PPP money, or you say, well, let's just ignore March and April, for instance. Okay, you can smooth that out. But if it's bigger than that, it's just hard to know what would happen in a second wave. There's a big city in China that's being shut down again today. I mean, it could happen. And that's more than just an equity risk. That's, I don't want to say suicidal, but it's crazy to take that sort of risk. So any company that's been seriously affected, as I said earlier, I just don't see any prospect of getting a smart deal done this year.
So what you're saying is risk is the new old 4-letter word.
Well, we're paid to take risks at all levels of the capital structure, but we're not paid to be crazy. There's no return you can get for just rolling the dice, and the future is pretty murky for companies that are affected. everybody's talked about it, hospitality and restaurants. It's the deals that get done are going to be the disastrous things that need to get done only.
So seller financing is the new mezz, basically, and in order to be able to get it done, it has to have some predictable stream of some sort. And hospitals and retail, we keep going back to that, but I mean, not hospitals, restaurants and retail, we go back to that, but there are many other industries that have been impacted by this pretty dramatically. And you think about the trail, it's not just what they do, it's the people they serve that are impacted that are going to make a big difference. So I guess, Scott, the question from me to you is, in your world, are you seeing clients that were on one track before, maybe aggressively growing through acquisition, now having to retract and really work through their own internal issues and make it work for the future?
Yeah, I mean, well, yeah, sure. I mean, the gaining. Oh, the light just came on because I moved. But anyway, the gaining deal. I talked to him yesterday, and the buyer hasn't come back, but they're saying, look, I mean, this is opening up potentially opportunities for us in parts of the world where governments really need money, and so they're. You can kind of look. There's sort of two sides of this coin. I mean, and on the one hand, maybe they won't get sold today, this year, for what they thought they were going to put in their pocket pretty soon. On the other hand, they're exploring new opportunities that have opened up because of the distressed situation of, maybe they're, maybe somewhere in Africa, there's a country that needs to, figure out a way to get some money or something. So, I mean, there's that side of the thing. It just really, I think it's very business dependent, on kind of how things are affecting them. I mean, I've got one deal I'm working on now that, is a deal that shouldn't be we've all been talking about kind of the split between businesses that are very affected by, the COVID-19 situation and other businesses that really aren't affected. And I mean, these guys aren't really affected in the sense that, they're in the, IP area and, they've seen their usage go up. And so they're probably kind of under the old regime. On the other hand, the buyer has introduced, this gets to your financing thing, the seller financing thing is the new mezz or whatever. I mean, I talked to you about this before we started this, that the first time I've seen introduced what's referred to as rollover equity. But when you really look at the terms of it, there's kind of two classes of rollover equity. One that is the traditional skin in the game. You stay in with this equity until, we sell you, 5 years from now or whenever it is. But the other tranche of the rollover equity is really, it's basically just additional seller financing. There's a provisions in the agreement regarding, we will buy this percentage of your rollover equity back in 4 years, and we'll buy this percentage back in 5 years. So really, it's kind of packaged as rollover equity, but essentially it's kind of a hybrid of rollover equity in the sense that it's priced based on, in part, on fair market value 4 or 5 years down the road. So it's not basically just like a debt seller financing, but it's kind of an equity piece seller financing with with some twists on it. So I think that, and that's coming from a family office. I mean, I think that you're going to see, depending on how things go, I mean, obviously we all wait on pins and needles every day, reading the news and everything about where things are going. But I think you're going to see a fair amount of that additional seller financing in the form of rollover equity, or maybe just straight, we agree to, take back, a debt instrument, just traditional seller financing. So that's what I'm seeing in the deals I'm working on right now. And, I think everything's very deal specific depending on who the buyer is. And, basically, does the buyer have access to a mezz lender that will do a deal, or are they having to structure something just using their money and using the seller as the financing source, you know?
That makes sense. And we had talked about this the other day in terms of, are you actually, are they actually going to do deals now where they're buying 85% of the company? The seller is retaining a minority shareholder, just holding on to the equity until it's ready for the next turn. So Lee, when you think about these things, and you think about your clients, relatively speaking, what kinds of opportunities do you see out there in the market right now where there may be some overlooked areas?
Boy, I hope I get the right answer on this. Then I have the crystal ball.
Well, nobody knows what the wrong answer is, so it's got to be right.
It's tough to say. We have been really hammering on the things to stay away from, but the pharmaceutical world, I think there's some opportunities there. Manufacturing, depending on where you are, it's to Scott's point, it's all going to be industry specific. If I am looking at real estate, I've got to look at my rent roll. I've got to see who's there. I mean, there's a lot more certainty than I probably would before. I think before I would look at the location and look at the values and go from there. I would definitely look at the rent roll, but now I'm really scrutinizing the estoppels, the leases. I'm making sure they haven't called Neil. And there's a lot of, we keep saying the word uncertainty, but there's so much uncertainty right now. I mean, just think about some of the intangibles, if you will. You've got a key employee and they're dependent on daycare. The daycare is closed. So they aren't really devoting 100% of their time to the company. You just have to factor in some things that probably we didn't look at before.
And how about the fact that you bring up the daycare? Are people as productive from home as they are in the office? Is there something missing by not being in the office? And I think nobody really knows the answer to that quite yet. But so what that really brings me to is one of the key questions. IBIDAC aside, I had somebody come to me the other day and they were talking about their company. They said, "Oh, well, this person was offering me 10 multiples." They said, "They get me a 10 multiple on this." I said, "Go ahead. You should take that if you could get it and hire that person." Those kind of numbers were out there for a while, but I personally don't see them coming back anytime soon unless you are Netflix or a Jim Cramer COVID index type company. But for the 85% of the rest of the world, I see multiple contraction. I'd be very interested in everybody's thoughts on what they think. Colin, you're pretty practical guy. What's your thoughts on that?
No, I agree. I think you're really going to see multiple contraction. What's been fascinating me through this thing is the granular detail of private equity or strategics in evaluating transactions that even is more granular than it's ever been. In other words, working on a deal where instead of a financing partner looking at the business in its totality, a traditional line of credit, they're saying, well, you know what, we're going to start doing this location by location because they're in multiple cities. And so it becomes where it was industry multiple, and now it's what's your subset of the industry. And now it's kind of a subset of an industry, Matt, combined with the geography, depending especially where it is, right? Because when you look at the COVID cases, some areas of the country have been hit harder than others. And so it's not just the crystal ball, I think, that Lee, is talking about. And it's the is there a second wave? But okay, today, over the last 3 months, when you're looking at trends, what was that specific geography? What was the impact on that specific geography, whether it's healthcare, elective services, or food? And so I think the general rule is you will see multiple contraction. I do think that if there are industries and geographical areas that have weathered the storm, then the good money and the money on the side is going to go after that, and you're still going to see eyeballs.
So a stress market, like everybody's talking about, and then you get down to the real question, which is everybody on this call gets deeply involved in the details, from Darren to Tony to Colin to Scott to Lee to Neil to myself, and the question becomes: have we just expanded the due diligence process to where we now no longer have a 7-month cycle from start to finish on a deal, but due diligence has taken on a whole new world on itself? And does that, as providers and service providers and advisors and counselors to the buyers and sellers, and particularly for Darren as the guy who's going to write the check in the end of the day, is there a whole new education process that's going to slow the pace of deals down just by the nature of the due diligence and what we have to dig for, because the companies aren't prepared to give it to you? They don't know. They've never answered these questions before. The underwriters at the banks have hard enough time understanding a deal to begin with, let alone now they're going to have to be educated to a whole nother level. And as attorneys, all of you have deep responsibilities as fiduciaries to advise your clients and protect them. Is the due diligence cycle now a whole new thing?
So I guess you tell us. I mean, you guys, do you do quality of earnings work for people, and what have you guys been sitting around talking about in terms of what's going to be different for what you're doing on that? Because that would be a little microcosm of that question, on your end. We can talk about stuff like rep and warranty insurance. I think the due diligence is going to be a lot more involved from their end than, the quick turnaround process. And of course, you read all the articles that lawyers put out there about additional due diligence items to consider. So, there's certainly going to be more of that. But, that's a good question for you. Do you guys do that? And what are you seeing there on that?
Well turned, Scott. Well turned. I can see why they pay you big bucks.
Yeah.
But no, in the QOE and in the due diligence, we absolutely are going to have to expand our scope dramatically, because we have to go to the subtext now. And there are subtext items that before you took for granted and they really wouldn't have mattered much. But to Lee's point, who is on the rent rolls and what's really involved in that if you have real estate? What's really underneath the surface in terms of your predictive capability for earnings, and who's your supply chain? Are they reliable? Where's your demand coming from? Personally, we've been talking a lot about the impact of the destruction on the demand side of the equation on this. And in a lot of traditional businesses, there's a lot of demand side destruction that is unquantified at this point. And that's one of the unknowns. And then you have the different financing structures. The entire capital stack is going to be structured in a different way. So when we engineer a deal, to Tony and Colin's point, we're going to have to slice this a little bit. And we always have to be aware that the last thing you want to do is buy something, and 6 months later you have to call Neil up and say, we have a problem. We need your help. And you don't want to be in that position. So there's a lot of conversation about the unknown and the second wave, and how much of what you're hearing and seeing is reality and how much is hype. One of the key factors that we're looking at is the employment issue. Talent will be more available now, but truthfully, how much talent do you really need in the place to make it run? And will people overcut? Will earnings be dressed up in a way that is a result of overcutting? A lot of this is going to be done with overcutting and as we used to say on Wall Street, painting the tape. It looks good at the end of the close, but the day was kind of messy along the way, and tomorrow could be a messy day right after it. So there are a number of things that we have to look at in the quality of earnings. And with the C, there's a lot of hesitation as to how you're going to certify the ability for people to earn out going forward. So I think the due diligence is going to take longer, and I think companies are going to have a tougher time producing some of this stuff. Quite honestly, what do you think, Colin?
No, Matt, I agree with that. I think it's not rocket science. I mean, there's so many businesses that if they've got the right management team that really works hard on the pivot, that are just going to thrive. I've got a client, experiential retail, and they got shut down, and so suddenly they said, well, what are we going to do? How do we use our space? And so they started making PPE, the masks. We looked in the FDA. They totally called it a pivot. Does that make up for everything they've lost in locations across the country? Absolutely not. But they were able to churn some revenue and try to keep some of their people in place. It's the old adage. I mean, can we adapt to change or not? In the Nashville area in the last 3 months, we've had a tornado. We've had a pandemic. We had you can hear my accent, Matt. I mean, I'm not the smartest guy. It was some windstorm that has a name that I can't pronounce, but that knocked out power for 4 days, hundreds of thousands of people in Nashville, to then George Floyd, to protests, to curfews. And I went to my first drive-through funeral Tuesday. And so you look at all of the change to businesses and all of the ripple effects that have been talked about. And, to me, the real key is evaluating a management team and can they adjust, can they pivot to not only survive, but to thrive.
Yep, and I agree. And I think all the things you mentioned are all things that now were not in the due diligence before. How many due diligence items did we have before we had to really worry deeply about diversity? Probably not as much as you're going to have to be concerned about it going forward. And where are they located geographically to Lee's point? Another critical piece as to where it is.
Well, it's not like anybody other than you, Matt, would probably go out and hang out with me on the weekends anyway. But after I make this statement, it's going to be a fact. Because as an attorney, and Scott, you may feel the same way. It's really again a fascinating time because you look at disclosures in 34. Suddenly pandemics are all. You look at the impacts on rep and warranty. You look at the MAC clauses in APA. Look at force majeure clauses in contracts, and this is there are things that are being challenged that have been done for years in the practice of law, and in banking, and in private equity, and that so many things have changed, and it is a fascinating time. But I say that really, maybe it's not all that fascinating unless you're a corporate transactional attorney.
We're all reworking our risk factors, but it's like anything else. I bought some REIT stock, thinking I was brilliant, back, I guess it was March or something. It was the old proverbial catching the falling dagger thing, It went right down another 100, down from 18 down to, thought I was brilliant buying it at 7 or 5 or something. It went down to 2, and then they came out with their big SEC disclosure on it. And I read that thing and I'm like, oh my God, this is a nightmare. But, now it's gone back up some. But yeah, we're all going to feel that way if we really look at all the risks we have and all the complications that you're talking about now. I guess I could shut everybody down. But I think the quality of earnings thing, that really worries me, because I think that ties into what banks are going to do. It not just, more are they going to be putting the money in there than, the private equity firms. Some of them are going to specialize in sort of deciding to take that additional risk with, kind of in this gray area, but I'm not sure from the financing side where that really leaves us on some of these deals where they can't figure out a way to finance it that you don't have to bring in, the typical LBO lender packages. That worries me.
Well, Darren, what do you say to that on the QOEs and those things?
Well, moving back up maybe to 10,000 feet, I think there is both from the management team of the company and the banking team, the corporate development officer who's really working with it. There's got to be, maybe this plays a little bit into what you do, Matt, but there's just got to be a confidence in the management team's got their hands around what they can and can't control and how they're adapting to it. And they have an organized book, for lack of a better term, but they've analyzed a lot of these things and can get to how they believe their quality of earnings are going to be. Again, I'll go back to, say, Texas Roadhouse, who published their average store did, I don't know, somewhere around $110,000, $120,000 a week in sales over their 400 plus stores. And with their drive-through parking lot scenario, they had gotten their numbers up in early April to about 55 to 60,000 and told people at 70,000 a week, we can break even the way we restructured ourselves. And they've shown you how they've done it, how they keep their clients, their customers coming in efficient, how they deliver a fairly quality product, etc. And you had some confidence in how they went about it, how they analyzed all of it, and how they believe they will slowly open up back to having people in their restaurants with plexiglass and how they can seat them and etc. That, along with us as a team going in and talking to them and having that organized data. When I go to my credit team, if I can answer a lot of those questions and have some confidence in what the management team has gotten me, and I've been able to go in and ascertain and have very good answers to, my credit team gets a little more comfortable with maybe a 3 times multiple as possible, or instead of 2 or 2.25, because of the organization, the study of it, the presentation of it, and so forth. So organization, we talk about what all the risks are, and we all know we can't control them all. But on the other hand, we can be organized, can be thoughtful. We can put through some confidence to all teams to this is what we think we can get done at a certain level. And I think that becomes even more and more important from us understanding and digging into these opportunities and to those management teams covering as many bases as they can and giving an organized presentation that bolsters as much confidence as you can get over this next 6, 9, 12 months to get deals done.
And just in general, I've heard anywhere from 6 to 18 to 24 months is what people feel that this cycle might be before they get some solid footing of what they're looking at. 6, I think, is a little bit on the optimistic side. 24 may be a little bit long. What is your guys' feeling in terms of how long before we see some normalization, understanding that a lot of it depends on whether or not we actually get a vaccine or get this thing under control, or people just, it turns out to be one way or the other?
I'll jump in quickly. Matt, I do think the vaccine is the key here, because until then, it's kind of anybody's guess. The biggest cities were hit hard, of course, and is this going to migrate, and is everybody across the country going to get that, or are the areas that have been safe going to continue to be safe? Is there going to be a second wave? If there is a vaccine, how effective, how is it going to be distributed? What if the Chinese have a vaccine and they don't want to share? They've got 1 billion people of their own. The possible problems are immense. Post-vaccine, I don't think you'll need very long at all to understand where businesses stand, and probably from a macroeconomic standpoint where the whole country is. So 3 to 6 months after a vaccine, I think things will be up and running in a big way. But until there is, you just have huge sections of deals that are not going to be able to get done. Anyway, I don't want to be overly pessimistic, but I think Give me a vaccine, and then we'll go get some serious deals done.
Right. So is it really a market for the opportunistic? Neil, I'll bring you back into it this way. When you look at opportunistic deals, the old vulture funds, the old buyers of the broken toys. Is this a place where there's going to be opportunity for people that want to retire and don't want to stay for another cycle, businesses that really have to merge or go out? As you hear more and more talk, Neil, do you see that type of activity coming back around again?
I think it's going to, like everybody said, it's going to take time. I don't think anybody is making any decisions on the spur of the moment right now, because there's just so many unknowns. With people who are on the verge of retiring, they'd like to sell their business. Now is a rough time to do that, I think. I mean, there is opportunity, but it depends on what type of business we're talking about as well. But I think we're going to have to sit back and see what happens over the next 6 to 12 months as to what people do it. And right now, I think most of us would agree that in most sectors of business, your value is certainly suspect for the time being. And I think a lot of the few that I've talked to that are in that category, are going to want to try to hold on and see what happens over the next year, and hope that things improve, the value of their business goes up, or if not, then they may need my services to put them through a reorganization. But I think time is the biggest factor that everybody's going to try to cling to right now.
Right, and that's why I think that the economy is as much as they want it to go. I think Wall Street may be just slightly ahead of Main Street in this thing by a margin, because it is time, and it's going to take time for people to get comfortable to go back to the workplace, is what we're hearing. And it's going to take time for people to be very comfortable in making any kind of risk assessment or risk decision to extend themselves, take on more debt, take on more activities. And, for example, when I spoke to Tony, not to put words in his mouth, but one of the things we talked about was Tony is not running so fast to throw down 12 different term sheets. He's looking very carefully at all the aspects. Would you say that's fair, Tony?
Yeah, I mean, come on. I mean, normally you'd look at customers and you'd look at the top few or the concentration, and then you'd say, yeah, and the next 10 account for 30 or 40% of revenue. Well, gee, we have a company we own, and it's only 15 or 20% of revenue that's in gaming, but gaming is stopped, and so it's a significant impact. So things that wouldn't have the complete stoppage in certain areas is jarring to anyone who touches them. And so you're going to be digging, more deeply. And maybe that means you go a little more slowly, but there's a lot of risk out there.
There's that word again. But, all right. So as we come to the conclusion here today, I have 2 questions for everybody, and just be free to have an open discussion if you want afterwards. But I'd like to rotate around and ask each of you, understanding that, Neil, you're at a disadvantage in this question, but what does an attractive company look like from both the buy and sell side post-corona? And does anybody have any idea of what kind of multiples that they think would be reasonable in this kind of environment, given all that we've seen? We'll start with Colin.
Well, I think kind of what I've said before. I mean, clearly, from a buyer standpoint, cash and access to cash is huge. Those companies were healthy coming into this are at a huge advantage. And then from the other standpoint, I just think a solid management team that that is improvising, that pivots, that understands the ripples more so maybe than ever before. Of it's not just ripples within your industry that impact your business, but it's the tangential ripples that can impact your business as well. And so, man, I think the attractive companies, especially from a buy side, you got to have cash, and from a sell side, a solid management team.
Lee, what are your thoughts?
I think right now I'm looking at tech, e-commerce, platforms where the employees can work at home and it makes the company more efficient. I'm staying away from retail. I think real estate's tough, hospitality's tough, transportation's tough. There's just so many unknowns. Obviously, if the vaccine is announced, that changes everything. However, right now you've got to look what is making life easier for the companies that are robust. If you can replicate Amazon, I recommend doing that.
Me too. Scott, what are your thoughts?
I mean, I feel the same way the previous two speakers really. You're going to have companies that aren't greatly impacted, and those companies are still going to be attractive. And, the financing is an issue on the buy side. So that's probably not as frothy a market for these really attractive, target companies that it was, but they're still going to be attractive. And I assume there's going to be a fair amount of competition for them. So, it just depends. So that goes to are you a technology company that's actually thriving, or are you a, restaurant that's, teetering on the brink or something? So that dichotomy. And then from a, buyer standpoint, I think, was mentioned the access to money. Do you have the money? Because some of the financing could get difficult. So just kind of go along with what other people have said on all that.
Okay. And Darren, as the provider of the treasure, how do you view it?
Well, not to mimic everybody else's comments, but to probably dig down to what the banks are going to look at on deals, I think are going to go to the next levels are what's the collateral packages look like? Okay, if we get over the humps of the cash flow, the banks now are going to be looking for their second and third ways out, and those have to be better substantiated than the true old airball deals or multiples where we don't take collateral. So I think the scrutiny on your receivable basis, handling your lines of credit appropriately. If you start looking at term debt, appraisals on equipment and collateral, real estate, if you will, are going to have to bolster those term loans better than they did before, where you might just lend on, 2 times without that kind of thing, or 2.5. And then lastly, the guarantor structures aren't going to be as sloppy, I think is the term we use. I think guarantors are going to have to step up on these projects, and they're going to have some firepower to do it. These quick burn-offs or, light guarantees. I can't see a construction real estate loan going where you got completion guarantee and then drop down to 25% or less with the guarantor structure. So I think the scrutiny of the banks is going to be after they get past cash flows, they're going to be looking for collateral and guarantor liquidity strength to if they're wrong, they've got other avenues to get out. And welcome to senior banking.
So basically what you're telling me is the balance sheet matters again, and there will be no non-recourse loans floating out there on potential earnings.
Yeah, I think the haves can do that. We've talked about that. But those who have, the risk out there on what they look like or how much risks they've got in changes in the economy aren't going to have that luxury anymore. We're going to scrutinize more again collateral and guarantor strength on top of cash flows.
Right. So the lower middle market really needs to brace itself for traditional senior banking as it always was until the last number of years, and low interest rates aren't going to take them out of this problem because of the spreads.
Yeah, be organized. If you've analyzed it all, get it down in a presentation and get the confidence of that business development officer, because they advocate internally to get you that capital. So the better that account officer is, and the better you arm them with, the information, so that they can make that credit team confident in giving you a little more than they normally would. You guys do it the same in the due diligence world on the buy sell. I think that's ultimately important here over the next year and a half.
Do you see an increased demand for QOE and those kinds of evaluations in most of the deals now?
Well, the larger the bank, the more they understand and work in that HLT or highly leveraged transaction. They have groups that do that. A $20 billion bank like us, we have several people who do that, half a dozen that understand that. As you get into smaller banks, they really don't understand. I'm not picking on them. They just don't understand QOEs and utilize them as much because they don't play in the leverage market. So the answer is yes. In especially the areas of the bigger banks who deal with that all the time, and us smaller guys who dabble in it.
I have one other question and this goes for the group too. With all the cyber stuff and Lee's comment on technology, how much more critical is the SOC audit now than it was before?
Yeah, like QOE and reviews and audits, we as bankers try and use as many experts who have, environmental phase one type. We want to use those experts as much as we can to take off the shelf and eliminate risks that we can't be, be the jack of all trades in all of it. So all those things are very useful to getting our comfort level when we're lending grandma's money, if you will, into companies. And we have 3 or 4 Monday morning quarterbacks that scrutinize us. So the more of that type, they're all scrutinized, but the more of that type information available on deals, the better you see the senior bankers extend debt.
All right. And Neil, I'm going to go to you, and then I'm going to go to Tony. So the same question for you, Neil. Again, you're at a disadvantage here because you deal with those coming through. But as you do, given all that's been said, how are you counseling? How are you going to counsel the clients, or what are your thoughts, given that you're dealing with them just before, in many cases, they have to make a decision? And in the workout area, these are preemptive tactics that they need to be looking at and analysis they need to be undertaking in order to get through the traps.
Well, certainly you got to sit down and analyze, each individual business. One advantage in my area is, if you're putting a company into a reorganization and you have the opportunity to either try to reorganize or try to sell the assets through a 363 sale, you're going to be able to try to market, that business to either competitors. That's generally who's going to come in and be interested in a business as a competitor. And so if a competitor feels confident that they can get a good deal, very often you may be able to get a sale through. I think obviously in the environment we're in right now, everybody, whether it's, a deal that Scott's handling or a deal that I'm handling, is going to be extremely cautious. And you're going to have, due diligence in all of our areas. It's going to be, wrapped up to a much higher degree. So it's gonna be difficult as far as advising clients. You've got to try to analyze how best this business can succeed, and that's really you've got to go through, look at what changes need to be made, and whether it's personnel, whether it's type of material that they're producing, whether it's marketing. I mean, you've got to run all that by them and try to see what will work best for them.
I think you're absolutely right, and they have to be willing to look at things just as all the attorneys on this call and Darren have to look at things that would not normally be on their radar. So, Tony, as the buyer, I'm going to give you the last word of what is it that's an attractive company to you right now that would allow you to go forth and engage in that risk?
We have focused over the years on manufacturers, and in an advanced society like the United States, manufacturing occupies an ever smaller piece of the economy. But whether it's 20% or something like that, that's where we've played. So what we're looking at is where what we think we know about manufacturing overlaps with what we'd be excited to be involved in. We know a lot about automotive, and I think there'll be some opportunities there, picking and choosing, if you will, but really our focus will be on food. We're looking at one company right now that sells, sort of systems into bottling plants that is a pretty exciting opportunity for us, and not very affected, obviously, by COVID. So I think Lee said technology. You have to focus on something if you're going to get things done in this market, because it's going to be so many no's, things that either you don't want to do or just frankly can't get done. Food is my answer.
Food is always a good answer. Keeps you.
Everybody's got to eat.
Yes, they do. Yes, they do. Well, to wrap it up, what I'd like to do is just say thank you to each of you for participating. I think it's been a great conversation. Certainly touched on a lot of different topics. Bottom line is that due diligence is going to get deeper. Cash is king. There are no free lunches anymore, speaking of food. And multiples will probably contract. And, until things settle down, nobody really has an answer, which we know. But the best thing we can do is be talking about it. And each of you I've worked with in the past, and deeply appreciative of our relationship. And thank you for participating today. It's really been good. So this has been a great session. So thanks again, and we'll talk to you soon.